there. Welcome. You are listening to the Financial Survival Network, and you're also watching it as well if you're watching on YouTube. And I'm Kerry Lutz. Today is Cinco de Mayo, and it's time to talk with Danielle Park. We've got a lot of trends. Well, the question is, when do you know, how do you figure out if the trend is your friend or the trend is not your friend? And that, I guess, is the key to investing in dangerous times like these. And what do you do when you can't figure out what the trend is? Well, where do you think the trend is? Why don't you email us, kl@kerrylutz.com. So, Danielle, it's great to have you back as always. So we've had retracement almost perfectly along the Fibonacci numbers. For some reason, those numbers always work, and nobody has any idea why. And the question is, where is the trend at this point?
So the trend in terms of, if we're talking about the risk markets, the corporate debt and securities markets, they're definitely still in a downward trend, in a bear trend after peaking in February 20th. You've had a retracement after falling that really abrupt 37%. They've rallied, well, the S&P, for example, 35%, so it's only about 15% from its all-time high, but the trend is still negative, right? So you can celebrate making back losses, or you can look for where the next move is likely to be. And so far, the bears still have it in terms of dominance in this particular part of the cycle. And also, I think it's very important, so you have to define your timeline and your goal or modus operandi in this. And I think a lot of people get confused. A lot of the airwaves are taken up by people who are traders, who are looking for literally intraday moves in some cases and daily moves in others. They will go long, short. They may be long something for a few days or a day and then flip to neutral or short. So you have to be very careful if you don't have a rules-based system around that kind of an approach, which is, by the way, extremely dangerous and not easy to get right. In fact, 70% of people who do that end up blowing up. So I'm not saying it's impossible to do, but it is a whole sort of game of its own. And you have to be careful that if you're a person who's trying to invest and not trade, in other words, doesn't have a rule set around entry and exit points and rules that are defined in advance, that you don't get suckered into when someone says they're, buying something. The question is, well, what is their time horizon, and does it match with what you're trying to do? And I think too often people are on this kind of a long-term, they're told, or they're brainwashed, frankly, by the industry in many cases to be a, quote, long-term investor without any real idea of what that entails or what sort of volatility that sets them up for. So they're perpetually holding long assets very often. So in our particular method, we don't go short in our client accounts. We go long and we go neutral. So our idea of neutral is when you're trying to avoid market drawdowns. And indeed, we're positive year to date in our accounts. So it's working. Now, in terms of where we would be long equities and corporate debt again, that level would be considerably different than the one that we're currently at. So I think the other thing we need to pay attention to here is there's been this huge disconnect. We've talked about it so much about how equity markets and corporate debt have been in a world of their own dreaming thanks to Fed liquidity and speculative appetite. And you've really had a total disconnect between what growth, what earnings momentum you're seeing, and what prices and multiples people are paying for these instruments. And you had a quick sort of reconnect with that whole concept in the February to March sell-off. And I think that people are once again thinking, oh, it's going back up, so they must have fixed whatever it was that was broken. And indeed, I think that they stuck on some sticking plasters to the speculative fever again. But if you look at the data, it reminds me very much of when we were watching the credit crisis coming in late 2007, and we were tracking it. And the stock markets, continue to rally, even as the credit markets expressed extreme stress and all sorts of negative omens of what was coming economically and revenue-wise for companies, earnings-wise, all that. But people kept paying more and more multiple. And that speculative bubble didn't, in fact, burst until, in Canada's case, it was the summer of 2008. So like 6 months later, it finally capitulated. And then we had an abrupt 50% drop. So I think that's the kind of climate. It's reminding me very much of that again, where corporate securities are in a world of their own dreaming, and the bond market is sort of much more ominous in terms of its outlook and how quickly we're likely to recover, to this just astonishing economic decline that we've seen in the first quarter of the year.
Yeah, the rapidity of it and the intensity of it is just breathtaking. And we're still not opening up. Supposedly 31 states in the U.S. are at some stage of reopening. But how long it's going to take, all these things. And yet the earnings weren't, first quarter earnings were expectedly to be low. We've got to have negative GDP growth because nobody's buying anything. The only thing you're buying is online stuff. We still got lockdowns in large swaths of the planet. We look at China, and yeah, there might be reopened, all the factories, although you can't really believe everything they say to you. But they've got nobody to sell their products to. Nobody in China's buying them. And the rate of as people are shut down and they got no income coming in, you really can't afford all these things. I don't see a line out the door. Even though flat screens, I see everything really has gone down in price. Many, many things. Not so much real estate yet, but it's coming.
So I think it's very interesting, right? If you look at the last two major bear markets, you had it centered in the tech sector in 2000, very tech-centric, but it's still, the implosion still hit many parts of the economy and the entire stock market pretty much. Same thing in the 07 peak. You saw subprime debacle really infecting many other parts of the economy, spreading through real estate, of course. But in this case, you think about it, this is, all over the world having a very negative impact, and it is the rare sector that is not suffering. So this is quite a different beast in terms of the magnitude of what's coming in here. And I think that people's expectation, even if we look at the layoffs that are, your unemployment rate in the United States is, going to be something like 20% this year. And in Canada, we're already, had the most negative start to the year that we've had, worse than 2008. Our layoffs are worse. Our budget deficits, frankly, are off the charts. We're supposed to have in Canada, some $250 billion of spending needed for this pandemic, and that's only in a short-term expectation of what's needed, not assuming the thing goes on into 2021 before we even can potentially get, the spread under control. So I think, again, it's hitting at a time when corporations and households were the most indebted and over-levered, when speculators are the most levered they'd been in many years, and now governments are having to just take out and write checks in proportions that would have been just thought impossible in the past couple of downturns. And I think, people like Lacey Hunt, I put a podcast on, he's an economist, of course, at Hoisington Management. He does a really good job of explaining the impact when you have this much debt in an economy and you start throwing in the government piece and the asset buying piece with a vengeance, which is the same thing that Japan did, of course, in the last 30 years, and is the same thing that has happened in other cycles, frankly, through centuries, Kerry. You get these episodes where central banks go sort of AWOL, like completely off the rails, doing whatever and anything they feel like. And what ends up happening is you just make a much slower recovery thereafter. You make, it's harder for the economy to get back on its feet. You've still got all these zombies. You've still got all this dead debt that's just sitting there waiting to be written down. And that's really a dead weight. And on top of that, of course, we have the demographic problem of the aging population. And now we've got the slowing immigration story because of, the trade wars was part of it. And then the virus is the next wave of that. And just this protectionist bent that's really swept the world, and certainly in the West. Canada's import and export numbers were out today. They were horrendous on both sides. We are... we have the largest budget deficit of any of the 40 largest economies, and the U.S. is next. So you can argue that it doesn't matter and we have to do all these emergency things. Well, maybe fair enough, but the reality is that we're just adding to a tab that was enormous before we even started this mess. And the extent to which revenue comes back, I was writing about that also today. I think it's so important for people to understand that these deferral programs and loan programs, right, they only will help with liquidity in the very short run, because as soon as the deferral period is over, if revenue has not just come back to where it was, now you need even more revenue to be able to pay your backdated sort of rents and payments and debts, as well as your ongoing expenses. And we're looking at an economy that, even when it opens up, two main points. Number one, the spread will continue, in fact, accelerate when you open up. That's the very nature of more social contact. And secondly, we're going to have restrictions on how many people are allowed to patronize many of these establishments. So we're talking about not more revenue, we're talking about a fraction of the prior revenue to service even more payments. So that math doesn't add up.
Yeah, I couldn't agree with you more. And I've been thinking about this because you've got forbearances on homes here in the U.S. Supposedly, they're going to try to put that on the end of the mortgage. But then they got all these mortgage bonds that aren't going to get their interest and the amortization, because it's been tacked on to the end. And then you've got car companies doing it. You've got credit card companies doing it. Basically, everyone is doing it, because what's the point of foreclosing on a mortgage at this point? And you can't even foreclose. You can't sue anybody. Pretty much the courts are shut down. So what are you supposed to do? You really have no choice. And the other problem is that, credit problems in the economy at large really are not the proper venue courts are not the proper venue to handle these economic dislocations. If we have 1 million companies, 10 million companies go bankrupt, there's no way that the bankruptcy courts, the way they're currently constituted, can deal with this. So,
well, and it's like what you saw in the subprime debacle too in 2006-07. The lenders don't want to go in and seize a whole bunch of property and equipment and things that they can't move. So if there's not much buyers, it's just like they have to become a storage company, or they have to assume the maintenance and looking after properties that they're empty. And so they're really not built to respond to mass defaults. They're built to respond to here and there, but the mass is still paying. But in an environment where a whole bunch of people are having trouble and it's really a systemic impact, that's a whole different ballgame. And so their incentives then are to try and pretend and extend some more, right? To hope that this will just pass and everything will bounce back. And of course, the longer you go on, it really occurred to me the other day that I've said this before about how in, the 1999 debacle, how Enron's business model was revealed to be a fraud, right? These special purpose vehicles, putting debts off book and calling them assets and then levering those up and all that. The great prestidigitation that went on. And then after that whole fiasco, what happened really in the cycle following it was that a bunch of companies took that model, financial companies and real estate companies took that model and copied it in many countries around the world, right? And then you saw in this run-up that central banks really have gone from, supposed institutions of credibility to now gimmicking their way through every possible trick, including setting up special purpose vehicles off book to buy corporate debt, which is this new gig they've got, right? So again, because we've never cleansed this system, we keep putting this further and further out of the realm of anything economical or rational or mathematical, and we keep kicking the can, and the kick of the can this time is literally no one's paying anything, government's writing checks, in the hope that by this third quarter we're going to have a sharp recovery. I just don't see that. I think sentiment is changing for on a permanent basis in some ways. And you know what? That's actually a good thing for individual households. It needed to happen. They needed to stop going out, start cooking more. This whole work from home phenomenon, I think, has got legs. I think you're going to see a lot of real estate in major centers that was already overbuilt in the credit bubble, right? Huge balloon of supply. And now you've got like the Bank of Montreal, a major financial institution in Canada, announcing today that they think after even after the economy opens up, they may have 80% of their workforce still working from home, because they've figured out, holy cow, we can save millions of dollars not having this workforce downtown. And PS, in the back of everyone's mind is, even if we get a vaccine this time, how long till the next disruption comes, whether it be climate-based, some natural disaster, or another virus? So all of a sudden people see, this idea of how do we relocate our operations so they're not so concentrated and risk exposed in particular areas. I think that's the new trend.
That's a great point. And reurbanization, which seemed to have been the trend for the past 5-10 years, where the millennial generation was rediscovering the joys of urban living with better transportation, more convenient, you don't need a car. Well, that also is a breeding ground for these viruses, as witnessed by New York City, other densely populated cities. And we'll see what happens there. I mean, just where I live, there's 2 brand new Class A+, as they call them, office buildings that were literally just done like 6 months ago. And I don't know what their vacancy rate was. I have no idea. I didn't pay any attention. I just said, when I looked at them going up, I just said, that's really dumb. Like, why do they need that for? We got more than enough office space now. So our company's going to move out of crummier space into better space. Well, at some point, the space isn't going to be used. And I think you're right. The whole work from home thing, we've never seen such a mass implementation of it before. I've been working from home for 7 years, but most people, go to offices and such, and maybe that's going to be more and more a thing of the past for people.
Well, and also if you think about what happened as an investment theme and as what to do with all this free money that was floating around in the past few years when the economy was under its, output capacity. So there was not a great investment case in most, like manufacturing and key sectors. So what they did was they really piled money into private equity, which really focused on things like real estate. And a lot of ETFs and institutional managers said, fine, we'll go in and buy up real estate. Let's build more real estate. And, that theme went on for a decade and while money was flowing. And now if you look around, I think pretty much every city that you look around has a lot of empty real estate, especially in the commercial side for lease signs and all of that. And if you notice too, after the last downturn, the last wipeout took out a bunch of retailers, a bunch of gyms, World Gym and Fit for Less and Planet Fitness and all these companies took up huge amounts of retail space. And I remember thinking, I've been working out at a gym my entire life, but I go to the community center and I look around and think, holy cow, every mall now has a massive, facility with weights. So, and of course, they are going bankrupt because they had minimal cash and a lot of leverage. And so I think who's going to fill these spaces now? If we lose the gyms, the big box stores, all this thing, I think we're going to have to look at repurposing a lot of these properties. And that will matter not just on the ground in terms of jobs moving, changing, losses. It's going to matter in terms of prices, and it's going to matter in terms of investors in the space. I think they're in for a rough period here, as well they should, quite honestly, because they were being very haphazard and lackadaisical in their actual investment analysis and much more just throwing money around because it was cheap.
It's funny that you mentioned gyms, because I looked at them over the years just as an investor, and I said, who would want to be in this business? It's the worst business. You can't make any money at it. Kind of you make money on the landlord concessions on the front end of the lease. But I remember I belonged to this club in the 80s in Manhattan, high-end health club, tennis courts, all this, called the Vertical Club. And it was kind of like the first of these high-end clubs. And their key was that they had 15,000 members paying them a monthly fee, but only about 1,500 of these people would ever show up during a month. And then the cyclical aspects of it, Christmas time, New Year's, when you want to take off the weight, I'm going to go to the club. And I've been working out my whole life, so I never really cared about it. But I always said, this is a lousy business. You can't make money at it. And I think what you said is true, that these gyms have been holding on for dear life. And when the money was flowing, it was all good. But now it's going to be harder to keep members going. And the cash flow is drying up. And they can't afford to pay their rents. You know, we should talk about that too, Danielle. The retail apocalypse has been greatly speeded up. Supposedly, you know, old line retailer Neiman Marcus is preparing to file for bankruptcy. You've got a dozen
Macy's. I mean, huge names, right?
J.C. Penney, all of them, because you know people just don't shop that way. A lot of what you used to get your work wardrobe for, you don't need anymore because you don't go to an office. I've got like a closet full of jackets and suits that I wear a couple of jackets a week sometimes, and it's just hanging there, and I can't bring myself to get rid of it. And I got to believe I'm not the only one. What about from your standpoint, smaller company, your employees, I assume many working at home now. Are you going to continue this trend?
Well, it's a good question. You know, I would say a year ago, we were getting phone calls out of the blue from real estate brokers, commercial brokers they said they had buyers for our office building here. We've been here 17 years, very happy here, no plans to move, weren't finished with the space, but we were getting propositioned by people wanting to buy it. And I think that was probably the peak of this cycle. And if we had wanted to sell it, that would have been the right time to do it. Because now as I look around, you know, we do have most of our staff working from their home at this point. I own this building, so we circle in and out, my partner and I. The question does remain. You know, I sort of said, if the virus, just as an example, we don't have a vaccine, say, in the next 6 months or even in the next 12 months. How long are people supposed to leave their empty buildings and work from home? And at what point is it a complete behavioral change that they won't be going back to working in a shared space? If it's not essential or necessary, you know, to what extent is that superfluous to have that resource that's sitting there? But the next question is, if there's so much space for lease and so much space for sale, who's going to be buying it all, you know? And so I think this is really a great lesson for all of us in the sense of assets are lovely places to store value, but the point is, what is the carrying cost of the asset? To what point is it negative carry for you? And if you wish to divest yourself of it, what liquidity can you raise? And that means what can you collect from it in terms of income, or who can you sell it to in terms of for cash? And those questions, I think, are being asked from small to large businesses all across in many, many countries. And I think that, like I said, I think this is a behavioral shift. And I think that people are spending less by not having to commute each day. They are not having to buy as many clothes. They are not buying in restaurants.
Yeah.
Right? And they're saying, you know, and from a household perspective, this couldn't come at a better time. They absolutely need to have a way to repair their balance sheet, to heal, to save, and not spend as much. And this is really coming at a perfect time. So on a micro level, this is perfect for the household. If they can continue to have some cash flow, spend less and save more. They have more time to exercise. They have more time to make food instead of spending it all at drive-thrus. So very healthy trends overall. The question is, you know, what happens to the levered asset holders who are going to now need to downsize expenses and raise cash? And that's already with a boomer population that was already in that theme before this even happened, right? So I think that the divestiture of assets in favor of liquidity and cash is going to be a theme that's staying here for, I think, potentially the next foreseeable years.
Yeah, I think you might well be right. You know, in effect, what's happened here, Danielle, is that the trend has caught up with the technology. The technology's been here for many of you out there to work from home or remote locations. Like my kids, you know, they all worked for, I would call them millennial type companies, companies that kind of came into being during the millennial generations, for lack of a better term, ascendancy. And all of them are working from home now. And really, you could make an argument that maybe they're not as productive, but for my one daughter and my son, they could work in any of their company's facilities, any place in the world.
Yeah.
Any office they could go in and just work there. So really what we're talking about is the trend has finally caught up with the technology that's been there for probably a decade to make this practical. Like for certain companies, you just can't do it. You own a restaurant, my printing company, we couldn't conceive of people working at home. But lawyers, all right, lawyers are probably people, many of you lawyers out there, at least in need of supervision. And I know my son-in-law, lawyer at a big firm in New York, a lot of his work was taking place at home. He went to another firm and he was kind of, had to reposition himself. So he had to appear in the office more. But now for the past 2.5 months, he's working harder than ever. Lawyers generally, you don't have to worry about it. It's the other people who aren't going to do their job if nobody is if they're not accountable directly. So productivity will go down, but on the other hand, so will costs. So maybe it balances out in the end. It's such a fascinating thing, Danielle, to see trends change and to witness it. So many times you just see a trend happens and you don't know how it happened or anything else, and you just kind of accept it and go on. But here, we're actually watching the trends get made.
And also, if I'm correct, and I think this is the overall arching theme, I was talking about it before the pandemic, and I think it's been accelerated, as you said, is less is more. So we've come through a period of opulence and excess and free money and everybody having all the trappings of wealth with very little actual net equity. I think in this environment, it's not going to be impressive to have 4 stories of granite floors and all this fancy stuff, because if it's me, I always walk in and think, woo, who's paying for all this? Yes. Right? From a value-based proposition, it doesn't help. It's an egocentric thing to have flashy premises and, people walking around looking like they're very busy. In fact, if you're monitoring output instead of appearances, then you can tell. And some of the studies that have already been done, and this is why the banks, frankly, have noted, they're getting investment deals done by Skype and over the internet and not having to do all the expensive pomp and circumstance and show of it all. And it's just a much more efficient model. Right away, they think, wow, we could save so much money. And again, this is a time when earnings are coming under compression, when it's going to be harder to grow earnings in this environment, and it's going to be important to manage the balance sheet. So that means paying down debt. Well, to do that and invest, you're going to have to reduce your expenditures. And that is the key piece that everybody's focusing on right now.
Hey, and I'll give you another example, how these trends accelerate due to the technology. The technology is waiting, and then the trend meets the technology. My bank, for instance, a large, too big to fail national bank, we'll just call them that. Originally, they would let me do a few $1,000s of deposits scanning the check with my phone. And my business accounts, I had to go there and actually deposit the damn things. And it always annoyed the heck out of me. I could have gone to my officer and just said, let me do it. Well, now that all the banks are closed, they've allowed for any account that I have, any amount of deposit I can put through there. So I literally, and too big to fail, had a branch literally within walking distance of my house. But they closed that a couple of years ago because the rent got too high. So now it's 10 miles away. Now I never have to go there because they have an ATM machine in the CVS that I pay no fee for. And I don't have to go there anymore. So you wonder, well, do we don't need so many bank branches now, do we?
So does your bank not offer the deposits through your phone where you take a picture of the check?
But they offered it on personal accounts, not on my business accounts because I didn't have enough volume. In my law firm, we had thousands of checks coming in a month, and you could scan it. They gave you these scanners. But now, for these little accounts, they just said, don't bother coming in, just scan everything. And when I want to move money around the accounts, rather than like going online and having to like do ACHs all over. I just write checks between the accounts, scan them, and that's it. I mean, it's made my life, I don't want to say easier, but I don't have to leave the house. That's one less thing I have to leave the house for. And one thing, though, the social aspects of work, it's kind of like school. So you can't downplay the social aspects, interacting with people, connections that you make, friendships. But, I've been working from home for so long now, it's almost unnatural to me not to. The only reason I was thinking, the space is going to get so cheap, maybe I'll just rent a space for a studio, because it'll be better set up than what I have now. But then again, it's money that I don't have to spend. It just might make sense economically, capability-wise, but I'm not worrying about it now. For now, hey, right now the palm trees are behind me there. The wind's blowing through what little hair I have left. I was supposed to get my hair cut today. The person was coming to the house to cut my hair and my son's, but she got tied up, so it's tomorrow. But that's one less thing I need to leave the house for. Another one, like getting my hair cut. Hey,
and here's another thing. Even though I've been a lifelong gym goer, I've started circuit training at our house, and including running and push-ups, and doing like a rigorous, skipping, pull-ups, push-ups, all that stuff. I've really shown myself that I honestly don't need to go to the gym. And I feel kind of bad about that, but I always hated it in bad weather, and when you're leaving the office in the dark in the winter because it's dark by 5 and all that. So now I'm thinking to myself, who needs to even go to the gym? And this is a long, dying hard gym going human. And I'm just saying, you realize it's carbon free. Yeah. It's only on your own initiative, and then you can do it on your own time exactly. You don't waste time driving back and forth anywhere. And even when there's no virus, you go back or the virus subsides, you go back to the gym and you're going to think about picking up those dumbbells and think, who else just touched these?
Yeah, well, try not to get germophobic. I've been riding over 100 miles a week on my bicycle.
Good for you.
And, like I miss the other exercise, the circuits. I don't have my son's made a little mini circuit in the gym. He's been working out like a madman there. But my gym's like literally a 2-minute walk. So, but I totally know what you're saying, because for many years I was in the same boat as you. And I will welcome the reopening of the gym for sure. It's never a social thing for me. It's always about just going there, doing my business, and getting the heck out. But, hey, so one other trend here is people breaking the quarantine and credibility of government going down. I think we'll kind of leave it at this, but you've seen these protests. People are upset. There's a bit of irrationality on what constitutes an essential business and a non-essential business. I mean, Walmart, Target, they have food sections, so they've been deemed essential. But then they got all this other stuff. So you can go buy a flat screen TV, buy a camera, go get a wardrobe. I don't know who buys a wardrobe there, but I get my workout clothes at Walmart, and they last forever. And, the whole concept of essential, non-essential business, and then the efficacy of the theory of the lockdown, we just don't know. We don't have the numbers to know whether what we're doing is right or not. And rather than come out and honestly tell you this, they just say, oh, no, there'd be millions of people dead. Maybe they're right. Maybe they're wrong, but there appears to be conflicting research on the topic.
One stat that stood out to me this morning, Kerry, I just noticed this. So you have, in America, you have 4% of the world's population. You have 33% of the reported COVID cases. So something's not working well, whether it's shut down or whether it's opening up or whether it's late response, but you've got a disproportionate amount of reported cases relative to your population, and that's kind of troubling. And the opening up is only going to increase the spread, let's face it. Now, I'm not saying it's the wrong thing to do. I'm not the scientist expert in this area for sure, but I do know that as we here in Canada start to contemplate opening up this month as well, we are going to see more spread. That's just the way it is. So I just worry that this is not anything that people are used to. They think of things as, like a storm that passes and the next day it's sunny. I don't think that's this beast. And that makes me concerned about the knock-on effects that are going to continue for the next few quarters, probably.
Yeah, we don't know. Well, we don't really know how many cases China had. So they probably had multiples more but that's all idle speculation. But we know they weren't honest about the numbers for sure. That's a given. In the U.S., states that haven't had the lockdowns have got the same infection rate when adjusted for population and population density as states that did have the lockdowns. And the states with the worst records here, the worst record of infections, are generally northern states, highly densely populated. Another reason why the reurbanization trend might end. There's too much that we don't know about it, and I'm not pretending. I've not been paranoid about it or crazy about it. I said, there's a risk that I might get it, and if I do get it, there's also a risk that I'm not going to survive it. And you kind of have to learn to live with that. But point is, we just don't have enough information, and the people making the decisions, rather than saying, this is the best information we have right now, we could be wrong, rather than saying that, they act as if they're infallible, left, right arm of God out there saving lives. And, we need more transparency in this process to counteract the resentment and the feeling that that authoritarianism is setting in, and really so that we can kind of be a team here. I mean, my feeling is probably could have been a little bit better on the lockdown aspect, but I kind of felt like not enough info, and it really wasn't that bad around me here in Florida. We're the third largest population in the country of any state, and yet we're number 8 for infections, number 10 for deaths. And, so many of the people that died, unfortunately, were in elder homes, long-term care facilities. And why weren't we protecting those people who were most vulnerable? There's a lot of issues, and I don't pretend to know them all. But it's,
and you know what I think is important? Feeling. You're right. We don't know what the ultimate infection rate is going to be of the entire population in North America, for example, but the financial infection rate is extremely high here.
You agree.
And that's, my work every day is trying to mitigate that kind of impact and to make sure that we don't lose money and that we come through this period as best as possible. And that's difficult for some sectors for sure, but the extent to which they came into it well prepared, well funded, less leverage, these are the things we can control, and decisions we make in real time about when to cut losses, when to go more defensive, all that impacts extraordinarily. And I think that's what people really have to be thinking about. Not just, of course, their health, of course, exercise, don't drink too much, that's a big factor for COVID.
Sure.
Don't smoke, all those things. But also when we're talking about the impacts beyond just pure health, we have to be worried about financial infection here. And that's the one that I think people shouldn't get caught up in a rebound rally and think, oh, the risks have passed. I don't think the risks have been priced yet. And there's never been a single bear market that didn't revisit the lows at least a couple of times. And, we had at least three 20% rallies in the last bear market before it finished bottoming. And I think that we're in the midst of the first of a 2 or 3 at least in the next little while.
Hey, and I'll just go back. Danielle, we've known each other a long time now, 8-9 years. I met you in New York at the Hard Assets Show. We were still recovering from the aftermath of the 08-09 financial debacle. And you and I have talked about this many times, that there was another one coming that would probably be far worse because, as the old saying goes, and maybe you can refresh my recollection of who said it, we've learned absolutely nothing and we've forgotten nothing. And that's what's happened here. You and I knew this day was coming. Who knew it was going to be a pandemic that set it off? But it was written in stone, and people out there, you ignored us at your own peril. I couldn't agree with you more. I've kind of been preparing for this psychologically for 12 years now. And I wouldn't say that my preparation has paid off, but maybe in terms of, when you're in a global depression, sometimes the best thing you can do, the way to win, is to not lose.
Absolutely, and not get sucked in. You know that whole Robin Hood trend of giving away free trades and all that? Who's that served? That has totally harmed the retail investor who has been suckered into trying to be a trader in an environment where they don't have actual rules. They're just following clickbait and headlines. Yeah. And, that's all about making money for the institutions. That's got nothing to do with helping the individual investor, so to speak. And I still am contacted constantly by people through the blog who are in the gambling mentality. They don't have a lot of savings. They still have debt. They're trying to save for a house, all these things, while they're trying to day trade in financial markets. And I'm trying to say to them, listen, those are conflicting mentalities. You've got a gambling mindset when you need to have a saving mindset. And there is behavioral discipline that one can develop to help them through all these shocks. But it's a foundational process. You have to invest some time and effort in doing the right things before the crisis and paddling your way through it rather than keep rolling dice.
Yeah, and you've really devoted yourself to that. So I highly urge all of you out there to go to jugglingdynamite.com. Check the archives. Okay, we're not making this stuff up. Danielle, you've been talking about this till you're blue in the face. Fortunately, some people listen. You can't save everybody, but if you can save a few hundred here and a few thousand there, then you've really done a great deed, and we thank you for that. Make sure you check out Danielle's site, jugglingdynamite.com. Check out our site, Financial Survival Network. Email us, kl@kerrylutz.com. Tell us how you've been weathering the pandemic, both the health pandemic and the financial global pandemic that it's literally swept the globe. Email us, kl@kerrylutz.com. Danielle, we'll pick up with you in a couple of weeks.
Okay, thanks, Kerry.